Hello, my name is Justin Wood. I work for the Economist Corporate Network. I look after Southeast Asia. And today I'm here to tell you about our recent round of regional strategic forecast meetings that we've held right across the region. We hold these meetings twice a year, and it's a chance for us to debate and talk about the global economy and some of the big macro trends that are driving the economic picture over the next 18 months, and then in turn to interpret what that means for us running businesses here in Asia. So I'm just going to, over the next few minutes, give you some of the highlights from our meetings. It'll be very brief, but if you want more in-depth understanding of the things that we were talking about and the issues and what we expect over the next 18 months, do contact your local director of the Economist Corporate Network, who'd be delighted to come and talk to you and share our thoughts in more depth. So looking out over the next 18 months, let me talk about the developed economies first. If you look at America is of course doing very nicely. We think the recovery there, the economic recovery, continues to gather strength. The economy is creating jobs, things are improving. We think that the policies of quantitative easing that we've seen over the last years will come to an end. In fact, they will end in October next month. However, we don't think that's going to lead immediately to interest rates rising, which of course would be very significant for us here in Asia. We think interest rates will rise, but probably not until the tail end of next year, 2015. And so any risk attached to disturbance and turbulence in emerging markets certainly unlikely to happen now. And because these changes are so well telegraphed, we think that unlikely to happen at all. But America certainly doing very nicely. If you look at Europe, Europe's a bit more mixed. There are some parts of Europe which are doing very well. Certainly Germany and the UK are doing very nicely. The economies are growing very strongly. But if you look at the Eurozone as a whole, it's really a rather miserable picture. And we think that Europe is really in the middle of a lost decade, much like Japan experienced during the 1990s. If you look at compare America and Europe, if you look at the US economy today, it's about 8% bigger than it was back in 2008 when the global financial crisis struck. If you look at Europe, it's about 2% smaller. And unfortunately, Europe is not really growing. So it hasn't even recovered back to that level of 2008, and nor is it likely to in the immediate future. So Europe definitely looking rather weak and worrisome at the moment. And the tragedy of it is really that it's self-inflicted. It's really caused by all these austerity measures that Germany in particular has been encouraging and forcing onto the rest of Europe. And to our minds, this doesn't make any sense. If you look at Europe, government borrowing costs at the moment are at record lows. So the bond markets are not worried about government debt. They're prepared to lend money. If you look at unemployment, it is at, again, record highs. So clearly governments could borrow and they could spend and create employment-generating opportunities and get the economy growing again. The problem in Europe is that it's a recession caused by a lack of demand. And governments are incredibly well placed to stimulate that demand to get their economies going. But that doesn't look likely, and so we are worried that Europe is going to continue in this very weak vein. Third part of the developed markets is Japan. And if you look at the reform policies of Shinzo Abe, Abenomics, they seem to be working very well so far. However, our sense is that the impact is starting to weaken and starting to fade a little bit. The money printing, the quantitative easing, has certainly delivered a jolt to the economy. The Nikkei, as we know, has risen sharply, raising asset prices and confidence. The yen has weakened substantially, helping exporters. Inflation is back, so deflation, we think, is being banished. It's not really a good sort of inflation. It's more cost-push inflation rather than demand-pull. But nonetheless, it's better than deflation. The problem we have is the third arrow of Abenomics, the structural reforms. And there we are losing confidence that Shinzo Abe is going to make a meaningful difference to the country. If you look at their recent trade negotiations with Australia, where they've just concluded a free trade deal, these are two complementary economies. They don't really overlap. They're strong allies. They have been for a long time. There's a lot of complementarity between the two places. They're on good relations. And they really struggle to make a meaningful difference. If you look at beef, Australia, a big beef exporter, Japan, not a big beef producer. And Japan found it within itself to agree to reduce beef import tariffs from Australia down to 45% by 2030. That's the level of ambition that they seem to be showing in a situation where trade negotiations and structural reform should be quite easy. So we're losing a little bit of confidence that Japan is going to make a meaningful difference to that third arrow, and that really is the key to Japan's long-term health. What about emerging markets? Well, if you think about the emerging market universe, it's really about Asia. If you look at the incremental growth, economic growth that's going to be added to the global economy this year, 60% of incremental GDP will come from Asia. And really, Asia is about China. China is going to contribute 30% of all the new economic activity that the world experiences this year. China, the number one engine in the global economy at the moment. If you look outside Asia, the emerging market universe is suffering and really not doing anything particularly positive. Certainly, Russia and Brazil are in recession and really not doing anything at all. Looking at China in a bit more depth, China is slowing, but in our view that's a good thing, it's not a bad thing. We all know that China has some huge imbalances in terms of things like rising debt and misallocation of capital, bad investment spending, and a slowing economy enables those imbalances to be addressed, and it enables President Xi Jinping to put in place some of his reform programs. So we're not worried about a slowing China, we're actually encouraged by a slowing China so that those imbalances don't get any worse. Property is a concern. Property prices are falling. We think that that's likely to be there's going to be a government response with some stimulus to try to get the property market stable again. But we're not overly worried about property prices. If you look at affordability, property prices have been rising in China at about the same rate as incomes. So although prices are softening now, we don't think it's going to cause a crash, and we don't think it's going to derail the China story. Lots of things to watch in China, but we highlighted one in particular at our recent meetings, and that's political risk. We know that Xi Jinping has launched this huge anti-corruption campaign. But is it really an anti-corruption campaign, or is it more about shoring up his power base? And that's really what we think it is. The beginning of his 10-year term, he's aiming very high, targeting some very, very influential people in the country with his anti-corruption campaign, and we think it's really about removing rivals. And that does create political risk because there is a growing backlash against this process. And if you look at China in a sort of a 50, 60, 80-year time zone, the country has experienced several seismic political shifts. Our concern is that the pressure mounting for another major seismic shift in China is rising. We do expect President Xi to serve out his 10-year term, but watch the risk because it is growing. India, we're confident that India things are improving, getting better. If you look at growth, you can already see that it's accelerating, and we think it'll continue to accelerate. And in fact, by 2018, we're expecting the growth rate in India to overtake the growth rate in China, because the growth rate in India goes up and the growth rate in China is coming down. The issues in India are fairly simple. They just need to get the basics right. They need to sort out bureaucracy, they need to tackle corruption, they need to build infrastructure. It's not rocket science. It's not easy, but nor is it complicated. Modi, we think, has got a good record of tackling the basics when he was governor of Gujarat, and now that he's Prime Minister of the country, and also with an unprecedented majority in Parliament, we believe that he'll make progress on getting these basics done. So we're optimistic that he's going to improve the outlook for India. Last place to look at, Southeast Asia. Again, we're very positive. We see the region growing at about 5.5% a year, the ASEAN region. Lots of things driving the growth, but one of the most important is the strengthening investment cycle. By investment, I mean fixed asset investment, infrastructure, factories, houses. ASEAN has been underinvesting for many, many years, and they're now addressing that investment deficit. The investment rate is picking up, and this investment is going to drive strong growth in Southeast Asia in the medium term, and especially next year. 2015, lots of things to look forward to in Southeast Asia. We will see the unveiling of the ASEAN Economic Community. That is going to be significant, and indeed we're producing some research which we'll share with all of you in the next month or so, talking about what that means for companies. In Myanmar, there's going to be elections next year, possibly even a new constitution. In Thailand, there'll be elections next year. Again, definitely a new constitution. It'll be interesting to see what form the new democratic system in Thailand is going to take. In Vietnam, we think next year is going to be a good year. After several years of economic volatility, we're returning to stability. It's going to be a lower growth environment in Vietnam, but a more stable one, and that's positive for companies investing there. Malaysia and the Philippines, two star performers economically last year and this year. We think that story will continue next year. It'll be another strong performance from both of them. And I suppose the most exciting and certainly the most interesting economy right now in Southeast Asia is Indonesia, the biggest engine of the region. We have a new incoming president in Joko Widodo in October. And it's going to be fascinating to see how he responds to the leadership challenge of taking Indonesia to the next level. So that's, in a very quick nutshell, the sort of some of the things that we've been talking about at our regional strategic forecast meetings over the past week. If you'd like more information or more in-depth analysis, do contact your local director of the Economist Corporate Network, and we'd be delighted to come and talk to you in much greater depth. Thank you.